Yeah, I think we're headed toward a bubble for sure.
This is the Financial Side of Life podcast, episode 27.
Welcome to the Financial Side of Life podcast. Our mission, to empower you with smart financial strategies and show that it's possible to get a college education, save, invest, retire, or do whatever makes sense to help you live your best life. We'll meet amazing people and professionals who will share stories about how they do it, and together we hope to bring a little sanity to your complex financial life. And now, here is your host, Certified Financial Planner Pro and founder of Avea Financial Planning, Angie Furubotten-LaRosee.
Hey everybody, Angie Furubotten-LaRosee here, and I want to welcome you to the Financial Side of Life podcast. Today, my guest is Randy Hubbs. I know Randy as Mr. Hubbs because he was a teacher at my high school back in the 80s, and of course, we called all our teachers Mr. or Mrs. It's just a habit. So if I say it again, just go with it, all right? I'll try to call you Randy. He taught band, and I was in choir, so I never actually had him as a teacher, but he was so well known in our relatively small high school, so I knew who he was. We recently reconnected at a real estate investor meetup here in the Tri-Cities. As I talked about in the last podcast interview with Hilario Zaragoza, I've been learning about opportunities in real estate as an investment and have been networking through our local meetups. Randy's wife, Jana, was our featured speaker last month, and I was super surprised to learn about their journey in real estate investing. I had no idea. I had so many questions, I figured I would just have him on the program so he could share his story with all my listeners. So, Randy, thank you for coming. Welcome.
Well, thank you for having me.
Fantastic. So I always just like to start by asking about your background. Can you just kind of fill us in with your background?
Sure. I've had the career of my lifetime, which was wonderful. So as you were mentioning, I started out with, I was born and raised in the Tri-Cities. I was heading down the path of being a Hanford engineer. And I discovered real quickly that, I needed to follow my path, which, I thought the money was going to be what drove my career choice, but I decided I really wanted to do what I loved to do most, which was music. I've always had music in my heart and my head since I was a little kid, kind of an odd, quirky thing that way, but I really wanted to study music composition. I wanted to teach. I knew I wanted to teach from the time I was in high school, so I went through Central Washington University, got my degree, and started my first job in 1979 at Pasco High School, and as the band director there, so it was really a fun, unique opportunity to come into a AAA high school in my first year of teaching, and we just had an amazing time. I spent 7 years doing that, and then went on to Columbia Basin College and was the band director there for 28 years. I guess it was 8 years that I was at Pasco, and then 28 years at Columbia Basin College. So, and basically, I, really wanted the freedom to be able to teach and enjoy, but I didn't want to retire on a teacher's salary. And so that was one thing. I've always had a little bit of an entrepreneurial spirit about me. I grew up in a real estate family. My grandmother was really into wheeling and dealing and buying properties and renting them in Pasco area and Richland. And then as the time continued, she talked my parents into investing in a couple of rental homes as well. I saw how much they hated it, and they weren't very good landlords, but it was an amazing thing for me to witness. And then, of course, my father-in-law, my future father-in-law, was a realtor, also had a number of rental homes, and so we were surrounded by that. Yeah. Both my wife and I were, and so actually I got out of college. I came back into town, and a good friend of mine who still has a kitchen business here wanted to, but I found a house from an aunt of his that he was able to buy on a real estate contract, and so he said, hey, you want to come help me live in this house and help me fix it up? I'm going to sell it. So that was the first concept of fix and flip that I knew. We didn't call it flipping back then, but sure enough, we did that, and I got the bug. And so I had my future father-in-law. We weren't married yet, but he went out and found me a home and said, basically, when I call, if I find a great deal, you need to hop. Well, my first month of my first first year of teaching, we found a little home over in Pasco and purchased that. I let it sit vacant for the whole year because I had my hands full being a first year teacher, and spent the summer, and both my wife Jana and I strapped the tool belts on, and we fixed this home up and got it all ready to sell. And 1980, the market crashed, and it was amazing to watch some of the people that I was idolizing as really crushing it in real estate that lose their entire portfolios, and everything, went down the tube. And so it was real interesting watching, how people dealt with that. Some people just kind of packed up their stuff and never touched it again, and others came back with a vengeance. And so, but 1980s was tough. Interest rates went up. I mean, we had our little house. Instead of flipping it, we moved into it and lived in it for a couple of years. And then when it came time to buy our quote dream house of that time, we were paying 13.5% interest. And so it was interesting, unique times, and certainly in doing so, we continued on, bought a couple more rental homes, and realized buy and hold was an awesome option for us and kind of the path we wanted to go. But we were really tied into our careers, and from there we basically started flipping in the mid-90s, and that was really when I opened my first book and started, instead of listening to the advice and how to be a landlord from parents and grandparents and all the people around me, certainly learned how to do a lot of work on things. And so I was a hands-on kind of person. But we started flipping homes, and and the whole purpose behind that was to get enough capital built up to buy more buy and hold properties. And we were really interested in multifamily. So our first big purchase was 5 duplexes in a row in Kennewick, and which was basically in essence a 10-unit apartment, but we were able to buy those with what I call Freddie Fannie money. And so we bought them the traditional 30-year loan kind of option, and then we decided to add one a year. And so that's what we kind of worked toward doing. We were continuing to do some more flips to make that work until finally we had enough cash flow to where we didn't have to flip anymore, and evolved into that until we got what I call Freddie and Fannied out, which means we could no longer qualify for the homes with the traditional financing. So we ultimately had to move toward commercial. So that's when I kind of stepped back. It was time to get educated. I'd already read a number of books, and I started listening to podcasts. And this is back in 2000, I believe 7 is when we kind of reeled things in. I also saw the crash coming, so we really pulled back from any local investing, and so we got educated, took a course. My mentor in that course for apartment investing is one of my best friends now. He lives in Denver, Colorado, and matter of fact, we've partnered on several things just personally, and he taught me how to go out and buy apartment complexes. So we actually did our first syndication in 2009, which was a 32-unit apartment complex, and then continued buying apartments for a number of years, and got involved with resort property down in Belize, and we were in several markets out there, so I got comfortable investing outside of areas, and my wife does all of the management of the management companies, and ended up getting my broker's license in 2012 so we could capture passive losses. And so we created our own brokerage here that's focused around helping people with investment properties. So, in doing so, I've been involved. I think I told someone I've spent enough money on my real estate education to buy 4 doctorate degrees. And so, we constantly stay educated and involved there. And so now what we do is we invest passively with a lot of other real estate syndications, plus we are actually fund managers ourselves and run our own projects as well.
Wow, that's a lot. That's a lot to kind of wrap my head around.
Yeah, I when I get going, there's a little sense of flow there. I should have breathed in between there somewhere.
That's okay. I'll try to go into some areas because things come into my mind as you're saying stuff. So I find I did not know that you had family who were involved with real estate. So do you think that definitely helped you out getting started? You had that background on both Jana and your side of the family.
Absolutely. It made a huge difference because it taught, when I look back at my childhood, I have one quirky thing about me is I remember what I was thinking when I was 5 or 6 years old and things. And I remember distinctly listening to my parents lament a lot about, boy, we should have bought that place because now it's, sitting on the Columbia River. And at that time it was worth $14,000. It's now worth $400,000.
I think my parents have a story like that too.
Everybody does, and I kept listening to these woulda, shoulda, coulda stories, and it's sad because nobody typically takes that plunge, or very few people do, and so that's where I decided I wasn't going to be that person, and watched my dad make some pretty bad decisions. Even argued with him when I was in high school because there was 5 acres that he owned that my grandmother deeded over to him, where the guest house inn now sits on Clearwater Avenue, and he sold it for a song at the time, but he didn't do enough due diligence to know what the value of the property was.
Right. Interesting. So you've learned from others.
Yes, absolutely. And
mistakes in a way.
Yeah, for sure.
And not mistakes, are things that worked out well, I suppose.
Yeah, things that worked out well, things that don't go so well. That's how I functioned as a band director. The reason I got into being a band director is because my high school band director was so horrible and drove a lot of people out of it. So I decided that wasn't going to be me.
Right. Excellent. Okay. The other thing that you mentioned is that you were kind of doing some of this stuff you got started in 79 with your first house, and then 1980, the market crash. Or our real estate, were you saying that our real estate market crashed?
Yeah, we've gone through a couple of bad ones. It was interesting when the country was booming. We had an overnight sensation occur called the in-reactor closure.
Right.
And when that happened, there were for sale signs on every single street.
Right.
And so real estate, of course, at that point in time, it turned into a massive buyer's market because people had to get out and go find jobs elsewhere.
Right.
So we've had a couple of those ups and downs in the Tri-Cities. What's been interesting is those peaks and valleys have gotten less high and less shallow, and so as a result, and we're about to hit critical mass, which I think a lot of people don't understand about the Tri-Cities area, is that, we're only, this really developed in 1944 with all the alphabet homes in Richland, and so we actually started becoming a city, I guess, at that time. And aside from that, we were little farming communities. And so, now, that when you look at us compared to Walla Walla or Yakima or some of these other places, they're 100 years older than us by far.
Right.
And so, we're now coming into a population of almost 300,000. That's going to be happening real soon. And when that happens, we reach what they call critical mass, where we become more self-sufficient, which is a great thing because that helps us rely less and less on Hanford if something does go wrong. But, we're in a volatile situation with Hanford being what it is, but it's also a great situation because, in 2008, we got a big chunk of that money for our Hanford cleanup. So when other cities were suffering so bad, we really didn't see much of a bump there.
We didn't, yeah. And also during that time, you were talking that interest rates were really high. And so, as a real estate investor, did the fact that the rates were so high at that time, did that give you pause to think, well, now's not a good time to do something, or we have to do something differently because this is our current situation? How did that impact you?
Sure. I mean, what happened was people had to become more creative. We saw a lot of owner financing on part of the homes, and of course, a lot of those rules have changed, and some of those rules were developed that we currently have today due to what all occurred during that time. We saw a strange lending pattern occur leading into 2008, where basically if you had a pulse and could breathe, you could get a loan, and we know how that all worked out. And so there's always opportunity in real estate as far as investing, but the strategies have got to, they always change. And so having your finger on the pulse and getting educated on how to make that work is what's most important there. Right now we're in a huge seller's market, so our whole brokerage is focused around helping people buy, investment property, single family homes to typically Freddie Fannie 1 to 4 is what I call it. So in other words, that's again traditional financing, some of the best financing out there when you can leverage on these interest rates today on a 30-year, that it really helps for cash flow. But what we also see is the prices are so high right now on these homes to where the numbers don't necessarily work, and so it really requires analyzing it more like you would a commercial property, which is a mistake I see. I'm a realtor. However, my fellow realtors, unfortunately, most of them don't look at it that way, and so a lot of people get into some bad investments that way.
So, okay, so you were saying the strategies might change due to the situation. So we're in a lower interest rate environment still. It's not as low as it's been in the past, but it's not that much higher. Okay, so when you're talking about the market, are you talking about our local Tri-City market, or does what we're experiencing here in the Tri-Cities extend into many places in the country, or are we kind of local in the way our market is reacting right now?
Sure, that's a great question, because I happen to be in a couple of inner circle groups, and I travel all over the country. And one of the most high-power groups I'm in has got like 14 people in it, and they're from all over the country, East Coast, Midwest, California, and we even have some foreigners in these groups as well at times. And so this particular group, though, is made up of some real high-powered, in real estate investors, fund managers. And we're all singing the same song. We're seeing these trends everywhere.
Okay.
There's certain markets where there's a little bit better opportunity, and that tends to be in the Midwest. Housing prices are lower, so you can make the rent numbers work better. But usually the coastal areas, the East Coast, and of course we're all along the West Coast, the entire Pacific Northwest, we are seeing higher values there, and so it makes it more challenging finding good cash flowing deals. It depends on a person's age and their investment strategy, and so I always hold back on, giving just cash flow advice, because younger people, like I was when I started out, we've done very well with mortgage buy down and equity appreciation, and so if a person's young enough, today's prices shouldn't still necessarily scare a person away. They just may not be positively cash flowing a whole lot, but if you're cash flow neutral, you're going to ride this other wave of great tax benefits. You've got mortgage buy down, so you're getting 30 years, it's yours, or if I wouldn't. My personal investment philosophy, I don't want to, put that on someone else, because I'm personally very much about leverage, and so I would always go for that 30-year loan. But some people want to pay them off earlier so they can own them outright, and so that's a different strategy. And so it really, my job is to listen to what the client wants and see what we can do to tailor make something that fits their needs.
And so with this kind of hot market, which appears to be kind of hot all over, is there any indication of like it being a bubble, or not necessarily, or is there something we should be concerned about?
Sure.
As investors?
I think so. Generally, I see a lot of people, and I've seen this like 4 times in my life. I've been doing this 40 years, and it seems like we're on these 10-year cycles. But, I've seen a lot of people right now becoming instant real estate investors, and so they're really hot on it. When we were most aggressively buying, it was in 2009. Everyone thought we were crazy, and they were like, have you been under a rock? Have you not read a newspaper? The reason that we're upside down as a country is because of the real estate bubble. Why are you investing in real estate? But the old adage of buy low, sell high is exactly the reason. So you have to run kind of contrary to the crowd.
Right.
And the crowd's definitely, including Wall Street, is getting into heavy real estate purchases. And we're seeing lending guidelines really loosening up. I mean, you look at lending today compared to 2008 and 9 and 10, you had to really qualify back then. Today, we're getting into some of this crazy financing stuff again. So, I think we're headed toward a bubble for sure, or at least a correction. Is that going to happen in the Tri-Cities? Well, again, because we're hitting critical mass, because there's so much going on, we may see a lull. It may not be a crash. That'll depend a lot on whether we have Hanford funding through that. But I mean, if you just look at what's going on with our, things are different than they were in 2008. The entire world is hinged on the U.S. dollar right now. So if the U.S. dollar tanks, we're in trouble. But take a look at our debt, where we're at federally. And I mean, this is unsustainable. Something's got to happen. We just don't know when. And, there's the great predictors were predicting 2016, and here we are in 2019. I was talking to Robert Kiyosaki about this, personally. He said, you were predicting 2016 and what happened, and because he hit 2008 right on, he and Peter Schiff, and Robert basically said, well, there's so many things and there's so much technology and we have so many ways of kicking the can down the road that it's hard to say when this will happen and if, and it's certainly not going to be the same way, but that shouldn't keep someone, you can live in fear all the way through. At some point in time you have to pull the trigger.
Right.
So. Yeah.
So, but living in fear and being maybe a prudent, thoughtful investor might be, a little bit different. So, if we're thinking that things are going to shift or correct or burst, if it's a bubble, would this maybe not be a good time to get in if you were starting out as a new investor?
I think you will find that in any market there are opportunities, and so the key thing is getting, as a new investor you should look into jumping in. However, trying to do this thing on your own without getting educated is absolutely a rule for disaster. We've got, like I say, the one way a person can participate is being a passive investor and watching how the person who's, spinning those plates around is managing things. But again, doing your due diligence on a manager is super important, which is why I'm in these groups. I invest passively in a bunch of other things, but I'm mainly investing in that person.
Right.
That's where my confidence lies. And so trying to go at it on your own and buy a single family home rental without listening to advice or learning how to analyze, or just, taking some realtor's advice that, oh, this just needs a little carpet and paint and this will be great, not necessarily a good strategy.
And you mentioned that in your when you were talking about your background, is that you said you have basically the equivalent of a medical degree or PhD, because you've taken so much education. And so where would somebody get that kind of education? How do you go about getting educated, aside from the School of Hard Knocks?
Sure. Well, whoever's listening to this right now is obviously getting educated, so they're listening to your podcast, and there's a ton of great podcasts. I like Auto U, which is Automotive University, which is kind of my pun for get books on Audible, and go out and listen as you're doing your commutes versus listening to the top hits every day. Maybe listen to there's so many great books on personal development. Getting on business is so critical. If you're going to invest in real estate and do it on your own, you've got to think like a business person. You can't. I'm on a board of a landlord association here locally, and most people who rent properties, unfortunately, don't know what they're doing, and that sounds pretty hard, but they're unwilling to get educated. They're operating like my father-in-law did. He was successful, but not the best landlord. It's a business. It's customer service. We have our own property management company, and we don't call our residents tenants. We don't use that word. We call them residents, and we treat them as our customers. They are the people that make our management company work, and so we're serving them like when you go into a store and someone says, "May I help you?" But unfortunately, oftentimes the tenant is considered the enemy, which is the wrong thinking. I mean, completely wrong thinking. And so, beyond that, it's all about business and balance sheets and understanding how, to not commingle accounts and all this other stuff that Jana was talking about a couple weeks ago.
And something that really struck me when she was talking too, she talked about the tax code and how many thousands of pages the tax code is, and how we all kind of know the top 10 or 20 pages and the laws associated with those items. So, I mean, it just got me thinking, how would you even go beyond that, aside from sitting down and reading the full tax code?
One would. I would never suggest that. That'd be brain damage.
But talking to others or listening to others' analysis, or how would you go deeper?
Sure.
On that topic.
If you're going to be a real estate investor, it's really important that you have a very knowledgeable CPA, which, again, you want someone. First question to typically ask your CPA is, do you invest in real estate? If they don't, then, they may advise people on real estate, but they may not know all of the different things that are available. If you are investing in real estate, especially after the changes that have happened more recently in the Internal Revenue Code as a result of Trump, I mean, not getting political, Obama did some great things as far as creating the Jobs Act, and so, but Trump certainly look at where he comes from. He's a real estate guy, and so he wanted to see people investing back into Main Street, and that was the thing Obama was trying to do. It's just a different way of getting people to invest in Main Street. Is give them incentives to do so. So now we have opportunity zones, and we have all these other things that are happening, but the Internal Revenue Code is beyond 6,000 pages, and what Jana was basically saying, the first 30 pages are about paying tax. The next roughly 90 or 60 to 90 pages are about deferring tax. So most of us might have our 403B or our 401K or tax, annuities and ways to mitigate the costs, intercept investment before it goes before we have to pay the tax on that. But that's really what most tax professionals are working on, is those first 90 or so pages. The rest of it are not loopholes. They are congressional incentives that are about creating jobs. Real estate's an excellent vehicle to do that. So we get things like depreciation, we get cost segregation, so we get to do aggressive types of depreciation, bonus depreciation. But in addition to that, if you're running a business and you run it correctly, then you have all kinds of miles and meals and your education and all these things that are tax deductible, legally tax deductible. They're not loopholes.
Right.
And that, I hate that word, because, Congress passed these bills in order to create jobs. And so just being smart enough to utilize those and not being fearful of the IRS is a big part of this strategy.
Right. And she mentioned that you guys had gotten audited over the years, maybe 4 times, I think she said.
Yeah,
3 or 4?
We've been threatened for. One of them they dropped before they even got to it. But our most recent audit was 2015. And again, it's just, if you're keeping really good records and you're running your business as a real business, we weren't even there. We just we gave our CPA everything, and we were in Belize at the time and got the phone call and said everything's great. So yeah, it wasn't a problem.
Oh, I love it. Okay, so I want to know more about Belize too, because she mentioned that that at the talk last month as well. So I also remember you saying that you were investors in Texas, and I thought Tennessee and Belize. How does that come about? How does somebody do that, or how did you do it?
Sure. Well, I've actually get to hang out with some pretty amazing people, and one of those famous quotes that Robert Helms, who's host of the Real Estate Guys radio show, says, live where you want to live, but invest where the numbers make sense. And so that's what drove us into the markets we're in. And so going back to that story of driving out of Richland and having my parents look across the river and go, gee, I wish we would have bought that. We're actually specifically not just investing in Belize. Belize. We're investing in a niche market in Belize, which is a beautiful island of Ambergris Caye, and we had an opportunity to syndicate some hotel units there, which has now become the largest hotel development in the country. It is a Hilton Curio property, which that all happened afterwards, and so we syndicated 16 units of that whole hotel for our investors, and so that's what drives us to Belize a lot.
And you have some kind of relationship with Robert Kiyosaki, so can you share a little bit about that?
Sure. Again, through our association with different people out there, great, mentors. We go on an annual summit at sea that is hosted by the real estate guys. And so Robert Kiyosaki came on in 2012, and he's made it every year since, except for 1 year. And we've not only Robert, but I mean, just so many other great, people that you literally get to, spend time on a cruise ship with these people. It's not a cruise like most people would think. We're typically in the conference room much of that time, and so it's a high networking group that's made up of about 200 people. Okay. And so I've just gotten to know Robert over the years, had a chance to celebrate his 70th birthday with him, and through spending so much time, you ultimately become friends. And so that's been our access to Robert, as well as a number of other folks out there.
Okay.
Yeah.
And Robert Kiyosaki wrote the Rich Dad, Poor Dad books, and we'll put that in the show notes too, because that's a book I'm always, I have one that's for teens, I think, and I have it floating around my house. And I'm teaching high school kids through junior achievement, so I mention those kinds of things to them. So that's a great resource for sure. I wanted you to go ahead and tell us a little bit more about your business. And I don't even think I said your business name yet, Randy. So the Investment Housing Specialists is your business name. Can you tell a little bit about what you guys do through that business?
Sure. So as I think you mentioned earlier, I'm a real estate broker, and that whole business is focused around investing. However, because of the number of people being in the Tri-Cities, that as much as I have all over the years, a lot of people also want me to help list or sell their homes as well. So we have a parallel brand to that called Equity First Home Group, because you don't want investment housing specialists on the sign in your yard. And so and basically what we've done there is my son got highly trained down in Las Vegas with Keller Williams brokerage there. So we moved that business in. So we still have that business, but it's a business within a business. So my son runs the Equity First Home Group portion, and so we help make that introduction, and because he's an amazing agent when it comes to single family home sales. He also has some good investment experience. He bought his first investment property when he was 22, and so. But our main focus is helping investors either buy or sell these products, as well as get them educated about real estate investing. And our entire team is made up of real estate investors. So we've got a property management company within that. Kevin Glenn's awesome property manager. Our whole focus around that has been, we built that model around all the property management companies we've worked with over the years, because I'm not a landlord. That doesn't fit my model. I need to be an investor and don't have time to go work on rentals. So that's what property management's for. We designed it so that it focuses around the needs of the owner and what they need, and how to provide excellent customer service, because if we don't retain those residents, then all of a sudden the cash flow for the owner starts going down. They have make-ready costs and downtime, and so it becomes very costly for them. So so we have that piece in our business, and like I say, we're able to we evaluate everything as if it were a commercial property, so that all of our clients that come to us that want to buy something are able to make an intelligent decision. And then, of course, we also know how to market and sell these properties because, again, there's so many critical things that get left off of most multifamily listings I see around here. So it's just, that's our focus, and then, generally try to, help educate people outside that in terms of 1031 exchanges and the different kinds of, how to invest with your IRA, which then kind of rolls into our other business, which is Global Summit Management, and that's where we raise capital for different real estate projects. We've got a couple of local projects going on, one in the Spokane Valley, and then we have a new housing development we're dealing with right now here in the Tri-Cities as well.
And that's through syndication?
Yes, that's
Okay.
through
Can you describe what that is, too? Because that's a new term for me. I'm starting to get familiar with it, but...
Sure. Syndication, it sounds like an evil word. It sounds like the mob or the mafia.
It kind of does,
But the actual, what it means is it's aggregating people together.
Okay.
I mentioned the Jobs Act that during Obama's movement, where they were trying to help get more money onto Main Street versus Wall Street. And so by doing so, it opened up the ability for crowdfunding, which is a different type of syndication. But some of you have probably heard that. That's not any, people crowdfunded for various, rock concerts and things, projects forever. But, typically you get a T-shirt if you donated toward it or something like that.
Mm-hmm.
But, the crowdfunding that we see today has changed. There's a lot of big, Grant Cardone does a lot of crowdfunding with real, his followers and things like that. But syndication is taking a group of people together, and generally there's someone who's the fund manager who knows the ins and outs of how to do this. But it's you find a great deal on an apartment complex, and it may be worth several $1 million, but most people don't have that kind of money. Mm-hmm. And so generally those big projects, which we see them all around the Tri-Cities, are not owned by individuals. They're typically owned by groups of people, either through joint venturing of some kind, which is a smaller group, and a lot. Unfortunately, I mentioned this as well. Sometimes these people get together and say, "Hey, let's throw a bunch of money in and go buy this." Yeah, you don't want to do that.
That's a partnership, right?
Yeah, and you have to really watch how that goes. There's a lot of people wearing orange jumpsuits as a result of that.
Oh,
So,
no.
Yeah, so.
My dad we were just talking about this yesterday. My dad went into a couple of partnerships to buy a multifamily. This is back in the 80, right around 80 also. So his advice to me is to stay away from partnerships.
Sure, yeah.
And so I was curious the distinction between a partnership and a syndication.
Sure. So syndication, typically when you see these big apartment complexes going up around, those are oftentimes built by REITs, so the real estate investment trusts. So your retirement portfolio may have that little real estate portion in there. So, the skyscrapers in downtown Chicago and the big 300 plus unit apartment complexes that are being built around here are often being built by insurance companies, like I say, retirement programs. But, there's also some pretty large projects that get, where they raise capital and, bring investors on board for. And so it's a completely legal process if done right. And so I had to get trained for that. We have to meet these SEC guidelines, the Securities and Exchange Commission, and you have two options. You either register the security, and that's a very long, extensive process, and not one that most people have time for, because if it's a good deal, it won't last that long. And so typically then you can file an exemption. And so you have a special attorney that does that, not just any old attorney, not some attorney that says they do this, but they also, do, some other
Wills.
thing out there. Yeah. Yeah. It's got to be somebody who's, there's some rock stars that are just great. And, I highly encourage if someone does that, they go find the right SEC attorney that just does syndication. Okay. And so they'll put together a what they call a private placement memorandum. Usually there's an executive summary, just like there is with any kind of a stock market investment. Depending on the nature of the type of syndication it is, it may be for accredited investors only, which is people that have at least $1 million net worth, or they make $200,000 a year and have for the last 2 years and are in the foreseeable future, the next year will do so. Okay. Or if they're a married couple, that number bumps up to 300,000. So there's all kinds of rules tied to that. And so the accredited only is allow for advertisement. But if you're doing what they call a Rule 506B, that is we allow up to 35 non-accredited investors on that, and someone has to have a personal relationship developed with the person that's actually doing the syndication project. So it's very highly regulated by not only each state, and it's also through, like I say, the SEC. So there's a federal component with that as well. And so lots of education, lots of things need to be done legally to do that. But we've raised tons of capital and brought down amazing projects as a result of it. And that just allows a person who has a normal job that doesn't have time to learn how to do all this stuff to invest passively and get their money more diversified, and not all on Wall Street, but now they have an opportunity to make great returns through a great real estate investment.
Mm-hmm. So when you say great returns, is there sort of a range that is reasonable or expected or common?
It varies, and that's the thing. It's hard for a concept of, say, I oftentimes talk to my investors about, we're going to make X percent, for the first 5 years, and then you're going to get all your money back, and yet you stay in, and so your return becomes infinite. In other words, you've been made whole completely, and then you continue to cash flow on a quarterly basis because of the asset that we've purchased, and then when we sell, then they get another benefit to that as well. So the numbers, as far as specific interest rates range, all the way, we see things as low as 4 and 5%, but as high as going into double digits as well. Okay. Now, with the market being what it is and what we were talking about earlier, we're seeing less of those big double-digit returns. They're usually in the the lower teens, but there are definitely some opportunities out there that we're seeing that in. And certainly, it's not all just real estate. And we see oil and gas opportunities and things like that. And, we're involved with a number of other, different types of syndication. So it doesn't have to necessarily just be real estate.
Right. Okay.
And that's how most of the oil and gas ventures are done as well, as through syndication.
Okay. So you started with one rental and kind of are now in this world of syndication.
Sure.
To me, that's quite the journey. Really.
It has been. And
so how would you describe that whole experience? Is that what you set out to do? Or, can someone who is, thinking about investing in real estate do something similar? Or, what is it about this journey that really matters to you?
Sure. I always have considered myself pretty conservative, even though it sounds like, I say that, and yet, people who know me also know that I'm a skydiver, and I've, rode dirt bikes, and I scuba dive, and I do all these action sports. That's what I do for fun. But, and when it comes to investment, I'm always very cautious. I've always watched the market. We did not get hurt in 2008 by the crash. I'm watching very closely what we're doing right now, where the market's at. But, the biggest piece is getting educated. If you want to be hands-on and doing this stuff, you've got to first of all start somewhere, and usually that's with a single-family home rental or maybe a duplex. But some people just step off the cliff and move into an apartment space. All I can say on that is, if you're buying get into a strip mall or those kinds of investments, it's really important that you know what you're doing and you get highly educated and do your due diligence. And so that does take some time and efforts, and that's why we have passive investments. A lot of people don't have that kind of time.
Right.
So,
yeah. And expertise.
Right. Oh, sure.
They just have the money, right? That's
Exactly.
kind of what they're there to do. Okay. So as we wrap up our conversation today, I like to ask my guests, what would be maybe your key piece of advice if somebody was looking to get into real estate investing?
The main thing is that you have to, two things: get educated and take action. And it's so important to be with people that you know, like, and trust as well. I mean, you'll hear a lot of scary stories out there, and I think oftentimes that's just through people not doing their due diligence. But you at some point in time you have to pull the trigger, and so we call it analysis paralysis, and it's a scary thought. I know a guy who's just doing an amazing job as a wholesaler right now, but he's scared to death to buy his first buy and hold property. So there's once you've done it a few times, then it gets easier, and you realize that you become more comfortable with it. But unless you actually take action, it's never going to get done.
Right. Excellent. That's great advice. And I'm going to take your advice because I'm that person.
Sure.
I got that one rental and I'm kind of, stuck. I want to do something more. I'm just not quite sure where I fit in. And that's
Right.
one of the reasons why I'm starting to talk to people and to educate myself is where can I fit into this wide spectrum of real estate investing? Because I don't necessarily want to be a landlord either, or at least, beyond my one house. But anyway, so I'm going to take your advice as well. So,
Great.
Randy, thank you very much for coming on the show today and talking about your vast, years of experience. It's just super fascinating. I'm so glad to have run into you again because I never would have known any of this.
Oh, it was a pleasure reconnecting.
Yeah, and I hope people will be able to take something away that they can apply to their own financial situation. 'Cause
Sure.
This is all ways to help build wealth. And-
Exactly.
all right. Well, thank you very much. I appreciate it.
Thank you.
I want to thank my guest again for stopping by the podcast booth and sharing their unique story with us. And thank you for listening to today's program. Be sure to go to aveafp.com to check over the show notes for details and links from our conversation. Don't forget to send in your questions and I'll answer them in a special listener mailbag episode. So I invite you to come back and listen again, subscribe, and leave a 5-star review on iTunes or your favorite podcast app, or at aveafp.com. That's AVEA, F like financial, P like planning.com. Thank you for tuning in.